Well, good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is March. It's March 4th, and it is a Thursday. It is almost the end of the first week of the trading week of March. Sorry, I'm still back in March of 2020 with all this COVID. It's like a black hole. The market's going to open up in about an hour and 15, an hour and 20 minutes or so. It's 8:13 right now, Eastern time. Futures are down about 25 points. On the NASDAQ, the Dow's down about 16. Nothing really beyond randomness. The big report of the day is going to be jobless claims. We also have productivity and factory orders. Let's take a look at them. The big one is jobless claims. Why is this the big report? Because tells us the number of people applying for unemployment last week. This is current. This is week 227, February 27th. This data is very current, and it's telling us that last week we had 730,000 Americans applying for unemployment, which is not that far off. It's only about 100,000, 150,000 off the number we had last year at the peak of COVID. So this number isn't going down fast enough, or it's not subsiding. I'm hoping, fingers, toes crossed, I'm hoping that the number will be at 710,000 or lower, and or so that we are below the 4-week moving average, because this number just does not want to go down. And if people aren't getting new jobs, then it's going to impact the GDP, it's going to impact productivity, and so forth and so forth. Now, we also have productivity and costs. That's another big report. Not as big of a report, but it's another major report that's coming out today that we should focus on. And as you could see here, productivity and costs. Look at this. Following very slight revisions to the GDP, little changes expected. Non-farm productivity, negative 4.8, 4.6. If people aren't working, then productivity and cost is not going to increase. So that's a major issue. And then finally, we've got factory orders. Now, factory orders have been doing better than expected, and I'm very happy about that. They rose to about 2%, or let's see here, expected to rise to 2%. I apologize. They were at 1.1%, but at least they're positive, and at least they're not at 0.4. So this is very good, and it'd be great to see factory orders increase, because that's telling us there's more demand for stuff that's made in U.S. But again, jobless claims is the big report, and tomorrow we've got employment situation and international trade in goods and services. This report, international trade in goods and services, will give us a good indication or a good picture of where we stand with imports and exports from other countries, and the employment situation will give us a good monthly review of where we stand with the employment numbers and where the unemployment rate stands. Consensus is 175,000, but look at the range. Negative 100,000 to positive 312,000. That's just gambling. That means we have no idea where this number will land. And that's not positive, and that's very disappointing, because we only added about 49,000 in non-farm payroll in January. Disappointing increase of 49,000, and if we go backwards, it's going to be devastating. So I'm hoping the number A will be better than 49,000. B, it won't be negative, and hopefully it'll be above 175,000, and that unemployment numbers go lower instead of higher. I would hate to see 6.5%. But that's on the table tomorrow. But the big report today that can really put a damper on the market or cause the market to go the other way is the jobless claims. Look for a number that's below 760,000. If we're below 760,000, it'll have a bullish impact or influence on the market. And if we go above 760,000, that's bad. That's bad. So if we go back into the moving average, which is if we go above 760,000, we're not going to be in a good position. So again, I'm just pointing this out to you. Looking at the overall market, this is where the negative is right now. This is where the biggest downside is, the NASDAQ. We are now, let me just move these bars up. Let me just delete this real quick here. If you look at the NASDAQ, this is the 50-day moving average. This is the NASDAQ 100. We broke. Remember I told you we were just looking like we were going to go positive, and I said give it 2 days. We want to see 2 days completely above or 2 days completely below the average. Well, guess what? We are now 1 day completely below, and if this doesn't rally higher and touch the 50-day line, we're going to be 2 days below the 50-day moving average, which means we will officially be in twilight zone, which is the difference between the 200-day line and the 50-day line. And that's a very neutral place to be. Now, how are the other indices looking in terms of this? Well, the S&P looks like it's just about to break. So we could go back up, and the Nasdaq 100 only has 100 stocks. The S&P 500 is a lot more influential. But again, it looks like we're breaking the 50-day line and headed into the twilight zone. So I would be very, very cautious right now. But if you look at the Russell 2000, which has been my favorite index so far, we're not even at the 50-day moving average. As a matter of fact, all-time highs are 230, and we're currently at 217. We're like, we're like less than 10% away from all-time highs. So we are still bullish in the Russell, in the small cap stocks. Although, keep in mind, there is some correlation between the large caps and the small caps. And if we get hit hard in the Nasdaq, it will influence the Dow as well. The Dow Jones, also bullish. So this is the order. You've got the Russell, the most strongest. Then you've got the Dow. Then you've got the S&P. And then you've got the Nasdaq. I'll say that again. In terms of strength to weakness, you've got the Russell, then you've got the Dow, then you've got the S&P, then you've got the Nasdaq. So if I was to go short, I would be looking more towards the tech, biotech, and if I was looking towards strength, I would be looking at smaller companies or blue chip stocks. And remember, a lot of this is happening because of interest rates. The Dow Jones and the Russell have more value stocks versus speculative stocks because they're not big enough. And speculative stocks have more interest rate premium because they're more riskier. Because if you're looking at yield on an interest rate, then you got value stocks, then you've got high flyers. So the higher the yield, the higher the potential profit, the bigger interest rate risk will eat. Oop, just hit my mic. Sorry, I hope you don't hear that too much. The interest rate yield will impact those that have a higher impact on interest rates first. So speculative stocks will go down more, value stocks will go down less, interest rates will go down less. Again, it's the impact that interest rates have on stocks. So obviously the Nasdaq stocks are the highest flyers, so they have the biggest impact. Now, I wanted to show you something. This is my chart of all the various sectors in the S&P. And as you could see here, healthcare is the first, second, third, fourth, fifth, sixth, seventh place. And it's not looking very healthy right now, and it's down 3.19%. So if you were looking at it over a 30-day basis, healthcare, I'm just all over the place, would be an 8th spot. And if you look at it on the average, then I keep saying real estate, healthcare, and healthcare. I'm not talking about real estate. I don't know what, I probably want to talk about real estate, but I'm talking about healthcare. So the bottom line is healthcare is in 7th place. It's below consumer discretionary. And I would assume right now with all the stimulus that's coming into the market that healthcare would be higher, but it's not. So it looks like there's some downside pressure on healthcare. So today I'm going to give you 2 stocks that are breaking down. And this is good because the Nasdaq is breaking down, and I believe these stocks have the most correlation to the Nasdaq index. So the first one is Iovance Biotherapeutics. It's a biotech company. 1-year return, negative 4%. It's not really, it focuses on commercialization of cancer immunotherapy, but it doesn't seem like it's making big splashes in the biotech industry right now. It's sitting on the 200-day moving average. It's actually breaking the 200-day moving average, which tells me it's substantially weaker than the Nasdaq and the Dow and the S&P, and it has more downside to go. And if we expand our time frame, you could see that it could easily break this level, 33 level, and go all the way down to the 24 level, and that's the level I expect to see it at. As a matter of fact, if we go higher up, you'll see it even has gone lower, but this thing is breaking down. It made an all-time high beginning of the year. It tried to rally again. It could not take out the top. You guys know what a head and shoulders pattern is? Here's a shoulder, and here's the head, and here's the neckline right here. And we broke down right here. The gap broke down, and we're going lower. So I think this stock will go lower. So I would sell it right at these levels, and if it takes out this gap here, if it starts filling in this gap, I would be out of this stock. But again, shorting it near the 33 level, price target at about 24, and a stop loss at about 42. So I do like this stock for a short, ticker symbol IOVA. Next one is STE. What does it do? Surgical healthcare. 6% return over the last year. I'm not buying it. Should have done a lot better than that. We've had some of the best performance in a long time. So it made an all-time high, again, beginning of January, has broken down. We had a rally in the market since that time. This stock hasn't done squat. Again, it's breaking the 200-day moving average. I'm waiting for stocks that are breaking the 200-day moving average because the Nasdaq is breaking the 50-day moving average. So if this stock is breaking the 200-day moving average, it must be substantially weaker than the overall market. Now, if you look at a long-term chart, you will see this stock could easily go down to its base. The base is right around this moving average level right here, and that's near the $160 level. This is at a 170 right now. It could easily go to the 155, 160 level. And if it breaks this high, 180, I would be out of it. Because if it goes above this level here, let me go a little closer. If it takes out this level, the 180 level, the stock is moving back up. But I like to sell it right at the 170, put a buy stop to cover it right around the 180. And the target should be right at the 200-day right here, 155-ish. Right around there. If this thing breaks, it's going to break, and it's going to break. And I think it has the potential to actually go to about 100. So there could be some long-term potential. Again, both are healthcare stocks. Healthcare is in 7th place cumulatively and in 8th place non-cumulatively over the last 30 days. But I do like to look at it cumulatively, but it's definitely not breaking out or making all-time highs or doing anything special. So I do like shorts right now because the market's neutral. It's not bearish yet, but it's starting to look like it could get there a little bit. Also, as I mentioned before, and I'll mention it again because I mention this all the time. If you look at momentum levels on the Nasdaq, and I know a lot of people focus on this because nobody really talks about this outside of me. I don't know why, but they don't. But if you look at, it must be too simple. If you look at momentum levels on the 200-day line, you will see that we just started this thing, and we can go, if we break this 200-day line, there's a good chance we'll go to the 50th line and possibly to the 7th line, but we need to cool off. Look at it in perspective. Look at a 10-year chart. Look at this. Highest level, and look at the 20-year. Look at that. We need to cool off. We definitely need to cool off. And as far as the number of stocks trading above the 50-day line, we're near the bottom. Let me show you. So I think we're going to have a little bounce, but not sure how far that'll get. That was the 200-day. 72 out of 100 stocks trading above the 200-day moving average, but only 32 trading above the 50-day moving average. And if you look further, you will see that we're almost at the bottom, but I think we're going to go down to 20th percentile. So we still have another 10% of stocks. Another 10 stocks need to cool off before we start coming up on the 50-day moving average. And we need to see some more correction on the 200-day. Either way, the stock to short or to sell, and this can help you gain a hedge on your account as well. Remember that if you're looking to hedge your portfolio, IOVA and STE, both are breaking the 200-day moving average, STE and IOVA. Now, before you go, I've got something important for you. It shouldn't be a surprise that CEOs and billionaires behind the curtain are making secret moves. New research has exposed a shocking truth about corporate America and certain legal tactics they've been using to force the rise of their own stocks. This is nuts. But after months of investigations, yes, I had the Sherlock Holmes hat on, this former Wall Street insider is finally ready to reveal the details he discovered. And it could benefit amateur investors like you. You've got to click the link below to check this out. Again, you got to check this out. He's found a surprise that CEO and billionaires, what they're doing behind the curtains, quasi-legal tactics been using to force the rise of their own stocks. He's been investigating this for a month, and we're finally ready to break this story. You've got to check this out. You've got to see what these insiders are doing. The corporate America, this is really, really big. Really, really big. And again, it can benefit you, the amateur investor. He's been investigating this for months, and he's ready to tell you guys all about it. He's ready to blow the lid off of this. Click the link below, find out, get all the details. And make sure to like this video, subscribe to this channel if you're watching on YouTube, and stay ahead of the market by being the first to watch these videos and be notified when they come out. I want you guys to see this video. And remember, there's a short opportunity on IOVA and STE. And you guys have a great day. Tomorrow's Friday, weekend's almost here. Bye, everyone.